Before we dive in, please remember that this video is for educational and informational purposes only. I am not a financial advisor, and the content in this presentation is not intended to be a substitute for professional financial advice. You should always consult with a licensed and qualified professional before making any financial decisions. Your personal situation is unique, and the information presented here may not be suitable for your specific circumstances. Imagine a guy named Mark. He's 32. He's got a wife, Sarah, a new baby girl, and a golden retriever that sheds on everything. They just bought their first house in a decent suburb, the kind with a park down the street. It wasn't easy. They scraped together every penny for the down payment. They have a 30-year mortgage that feels like a mountain, student loans that are still hanging around, and the cost of diapers is frankly shocking. But they're happy. They're building a life. One Tuesday morning, Mark kisses Sarah and the baby goodbye, heads to his construction management job, and never comes home. A freak accident on the job site. A 1 in a million tragedy. In an instant, Sarah's world shatters. And after the initial tidal wave of grief, a second, colder wave starts to crash down. Reality. How does she pay that mortgage next month? How does she cover the car payment? The student loans? How can she possibly afford daycare to go back to work, let alone save for their daughter's future? Mark was the primary earner. His income wasn't just important. It was the foundation their entire life was built on. Suddenly, Sarah is facing not just the loss of her husband, but the potential loss of their home, their stability, their future. That story, or some version of it, is why we're here. Because for every family like Mark and Sarah's that faces financial ruin, there's another family that doesn't. And the difference, the single piece of paper that changes everything, is life insurance. Over the next 10 parts, we are going to pull back the curtain on one of the most important, and yet most misunderstood financial tools in the United States. We're going to strip away the confusing jargon, cut through the high-pressure sales tactics, and give you the raw, unbiased truth you need to protect the people you love. No fluff, no agenda, just clarity. By the end of this series, you won't just understand life insurance. You'll be able to make a confident, informed decision for yourself and your family. So let's start at the very beginning. What is life insurance at its absolute core? Forget everything you think you know. At its simplest, life insurance is a contract. It's a formal promise between you and an insurance company. You agree to pay a certain amount of money on a regular basis. This is called the premium. In exchange for your payments, the insurance company makes a legally binding promise. If you pass away while the contract is active, they will pay a large, predetermined, and almost always tax-free sum of money to the person or people you choose. This lump sum of cash is called the death benefit. That's it. That's the entire mechanism. You pay small amounts over time, and in return, your loved ones get a big amount if the worst should happen. It's a financial safety net, designed to catch your family when they need it most. It replaces your income, pays off debts, and gives your family the breathing room to grieve without the immediate terror of financial collapse. If it's that simple, why is it so confusing? Why does the topic make so many of us want to close the browser tab and go watch cat videos? It's because the industry has wrapped this simple concept in layers of complexity and jargon. Words like term, whole, universal life, riders, cash value, underwriting. It feels like you need a finance degree just to understand the basics. And let's be honest, it's a topic we naturally avoid. Nobody wants to sit around on a Saturday morning thinking about their own mortality. It's uncomfortable. But facing a little discomfort now can prevent a lifetime of hardship for your family later. Our goal is to make it comfortable, to make it clear. To do that, let's meet the 4 key players in any life insurance policy. Understanding these roles is the foundation for everything else. First, you have the insurance company, or the insurer. This is the big company, think Prudential, New York Life, State Farm. They are the ones who create the contract, collect the premiums, and most importantly, pay out the death benefit when the time comes. They're the other side of the promise. Second, there's the policy owner. This is the person who owns and controls the contract. The owner is responsible for paying the premiums. The owner is the only one who can make changes to the policy, like changing who gets the money. In most common scenarios, if you're buying a policy for yourself, you are the policy owner. Third, we have the insured. This is the person whose life is covered by the policy. The insurance company is betting on the lifespan of the insured. When the insured person passes away, the death benefit is paid out. Often, the policy owner and the insured are the same person. For example, I own a policy that insures my own life. But they don't have to be. A business might own a policy on a key executive, making the business the owner and the executive the insured. Finally, and most importantly, you have the beneficiary. This is the person, the people, or even the entity like a trust, who will receive the death benefit when the insured person dies. This is the why. This is Sarah and her baby girl in our story. You can name one beneficiary, or you can split it among multiple people, your spouse, your kids, your parents. This is who you are protecting. So let's put it all together with Mark's story. Mark would have been both the policy owner and the insured. He bought the policy and paid the premiums, and it was his life that was covered. The insurance company would be the company he bought the policy from. And the beneficiaries would have been Sarah and their daughter. When Mark passed away, the insurance company would have sent a check, say for $500,000 tax-free, directly to Sarah. That money would have been hers to use however she needed. To pay off the mortgage, to set up a college fund, to simply replace Mark's income for the next several years while she got back on her feet. It wouldn't bring Mark back, but it would have saved their future. Now, you might be thinking, how can this possibly work? How can a company take, say, $100 a month from me and promise to pay out $500,000? Sounds too good to be true. The magic behind it is a concept called risk pooling. Imagine a village of 1,000 families. They all know that, eventually, tragedy will strike one of them. So they all agree to put $10 into a community chest every single month. That's $10,000 a month going into the pot. If one of the family's providers suddenly passes away, the village leaders take a large sum, say $100,000, from that community chest and give it to the grieving family to help them survive. The individual contribution is small and manageable, just $10. But the collective benefit is huge and life-changing. No single family could save that much on their own, but by pooling their resources and sharing the risk, they create a powerful safety net for everyone. Life insurance companies do this on a massive scale. They collect premiums from millions of people. They use complex math and statistics called actuarial science to predict how many people in that large group are likely to pass away in a given year. They know that only a small fraction of their policyholders will die each year, so the premiums collected from the many can easily cover the death benefits owed to the few. They invest the rest of the money to grow it over time, ensuring they'll always have the funds to pay claims decades into the future. It's a simple, powerful, centuries-old concept, the strength of the many protecting the individual. So we've established what life insurance. We've pulled back the curtain on the basic what and how. But the real question, the one that's probably on your mind right now is this for me? Do I actually need it? And if I do, how on earth do I figure out how much? That's where the real power lies, and that's the next piece of the puzzle. Let's start with a simple, brutal truth. Life insurance isn't for you. It's for them. It's for the people you love, the people who depend on you, the people whose world would be turned upside down if you were suddenly gone. You will never see a single penny from your life insurance policy. And that's the entire point. It's one of the most selfless financial decisions you can ever make. So the question, do I need it? Isn't really about you. The real question is, would anyone suffer financially if my income disappeared tomorrow? If the answer is yes, then you need to listen closely. Let's talk about the obvious scenario first. Meet Mark and Jessica. They're in their early 30s, just bought their first house, have a 2-year-old daughter, and another baby on the way. They have a mortgage payment, 2 car payments, and the ever-growing mountain of expenses that comes with raising a family. They both work, and their combined income just covers everything, with a little left over for savings. If Mark's income vanished, could Jessica handle the mortgage, the cars, the childcare, and the future college bills on her salary alone? The answer is a terrifying, resounding no. She'd be faced with impossible choices. Sell the family home? Go back to work weeks after having a new baby? Derail her own career to take a second job? For them, life insurance isn't a luxury. It's the financial foundation that ensures their family can stay a family, in their home, with their dreams intact, even if the worst happens. It replaces that lost income, pays off the mortgage, and secures their children's future. It's a plan for the chaos. But what if you're not Mark or Jessica? What if you're single? Let's talk about Chloe. She's 26, single, no kids, and rents an apartment. On the surface, it seems like she's the classic case of someone who doesn't need life insurance. But Chloe has a secret roommate, $60,000 in private student loan debt. And her parents, who wanted to give her the best shot at her dream career, co-signed those loans. If something were to happen to Chloe, that debt doesn't just disappear. The lenders would come knocking on her parents' door, demanding the full amount. Her parents, who are nearing retirement, would be legally on the hook for her debt. Their golden years would be spent paying off a loan for a degree their daughter never got to fully use. For Chloe, a small, inexpensive life insurance policy isn't about protecting a spouse or kids she doesn't have. It's about protecting her parents from her promises. It's about making sure her legacy is one of love, not of liability. And it's not just about debt. Think about the stay-at-home parent. It's a common mistake to think that only the breadwinner needs life insurance. Let's go back to Mark and Jessica. What if Jessica was the one who passed away? She doesn't have a traditional income, so they're fine, right? Absolutely not. Think about the economic value she provides. Who will take care of the kids? The cost of full-time childcare in the United States can be astronomical, easily $20,000 or $30,000 a year or more. Who will manage the household, the cooking, the cleaning, the scheduling? Mark would either have to pay for these services or drastically reduce his own working hours, crippling his income and career. The economic contribution of a stay-at-home parent is immense, and replacing it costs a fortune. Life insurance acknowledges that value and provides the funds to keep the family running smoothly. The list goes on. Are you a business owner with a partner? If you die, what happens to your half of the business? Does your partner have the cash to buy out your share from your family? Or will your spouse, who knows nothing about the business, suddenly become their new partner? It's a recipe for disaster. Life insurance can fund what's called a buy-sell agreement, providing your partner with the exact amount of cash needed to buy your share, ensuring the business survives and your family gets the fair value of your life's work. So, who doesn't need it? Honestly, very few people. If you are single, have zero debt, no one depends on you financially, and you have enough money saved up to cover your own funeral and final expenses, then you might be in the clear. If you're independently wealthy and your assets are more than enough to provide for your loved ones for the rest of their lives, you might not need it either. For pretty much everyone else, it's a critical piece of the puzzle. Okay, let's say you're convinced. You've realized that someone somewhere would be in a tough spot if you were gone. That brings us to the second, even more intimidating question. How much? How do you put a number on a lifetime of earnings, on a future you're trying to protect? Financial advisors have all sorts of complex calculators and formulas, but you don't need to be a math genius. You just need a simple framework. Let's call it the LAFE method. It stands for liabilities, income, final expenses, and education. First, L is for liabilities. This is the easy part. Make a list of every single debt you have. Your mortgage balance, your car loans, your student loans, your credit card debt. Add it all up. This is the bare minimum amount you'd want a policy to cover. To wipe the slate clean we add it all up. $320,000 plus $700,000 plus $25,000 plus $300,000. The grand total is $1,345,000. That sounds like an impossibly huge number. $1 million policy? But here's the secret you don't know yet. For a healthy 30-year-old, a policy of that size can be surprisingly, shockingly affordable. And now you have the power. You know the why, and you have a clear, simple framework to figure out the how much. You're already ahead of 90% of the population. But this is where the road splits. This is where most people get overwhelmed and give up. Because once you have that number, you step into a world of confusing jargon and conflicting advice. You hear words like term, whole life, universal variable. Feels like a different language designed to confuse you. And here's the critical part. Choosing the wrong type of life insurance isn't just a small mistake. It's a decision that can cost you tens or even hundreds of thousands of dollars over your lifetime. It's the difference between a simple, affordable safety net and a complex, expensive financial product that might not even be right for you. So, what are these different types? And how in the world do you choose the right one for your plan? That is the next and most important piece of the puzzle. Alright, let's solve this puzzle. When you walk into the world of life insurance, it feels like stepping into a giant, confusing supermarket. There are hundreds of brands on the shelves, all screaming for your attention. But before you even look at the brands, the specific companies, you have to make a much bigger choice. You have to decide which aisle to even walk down. And in this world, there are really only two main aisles. Everything else is just a variation. The first aisle is called term life. The second is called permanent life. This is the fundamental fork in the road, and the path you choose will change everything about your policy. How much it costs, how long it lasts, and what it actually does for you. Get this choice right, and you're on your way to a smart financial plan. Get it wrong, and you could waste tens of thousands of dollars over your lifetime. So let's start in the first aisle. The simple, straightforward, and by far the most popular one, term life insurance. The name tells you almost everything you need to know. You are buying life insurance for a specific term or period of time. Typically, this is 10, 20, or 30 years. You and the insurance company make a simple deal. You agree to pay a fixed monthly price called a premium for the entire term. In exchange, the company agrees that if you pass away at any point during that term, they will pay out the full tax-free death benefit to your family. If the term ends and you're still alive and well, which is what everyone hopes for, the deal is over. The policy expires. You stop paying and the coverage ends. You don't get any of your money back. Think of it like this: term life insurance is like renting an apartment. You pay your rent every month and in return you get a roof over your head. It's an incredibly important form of protection. But when your lease is up, you don't get to keep the apartment. You don't build any equity. You were simply paying for the protection you needed for the time you needed it. And this is precisely why most financial experts recommend term insurance for the vast majority of people. Because for most of us, our biggest financial risks are also temporary. Consider a young couple who just bought their first house and had their first child. Their biggest risks are the 30-year mortgage and the 20 or so years it'll take to raise that child to financial independence. They need a massive financial safety net right now, while their debt is high and their kids are young. But they don't necessarily need that same massive net 35 years from now when the house is paid off, the kids are grown, and they have a lifetime of savings built up. A 30-year term policy is a perfect, laser-focused solution for that problem. It's designed to do one job and one job only: replace your income and cover your debts during your highest risk years. And because it's so simple, it is shockingly affordable. A healthy 30-year-old can often get a $500,000, 20-year term policy for about $25 to $30 a month. For many people, that's less than a couple of streaming subscriptions. It is the cheapest way to buy the most protection. It's simple, it's effective, and it's a financial tool that has protected millions of families. But it has that one big catch. It ends. What happens if you still want or need coverage after your 20 or 30-year term is up? Well, you'll be much older and potentially less healthy, meaning buying a new policy will be astronomically more expensive if you can even qualify for one at all. And that exact fear, the fear of outliving your coverage, is what leads us down the second aisle. The more complex, more expensive, and more controversial aisle: permanent life insurance. If term is like renting, permanent is like buying a house. It's a much bigger financial commitment. The monthly payments are significantly higher, but in exchange, you're not just paying for protection. You're also building something of value over time. Permanent life insurance is designed to do exactly what the name implies: last for your entire life. As long as you keep paying the premiums, the policy will never expire. It guarantees a payout to your family, whether you pass away at age 50 or age 100. But here's the game-changing difference. A portion of your higher premium payment doesn't just go towards the cost of the insurance. It goes into a special, separate account inside the policy called the cash value. This cash value is a savings and investment component that grows over time, tax-deferred. It's your equity in the policy, and once it grows large enough, you can actually borrow against it or even withdraw from it while you're still alive. This transforms the policy from a simple safety net into a complex financial asset. It's not just a death benefit anymore. It's also a forced savings plan, an investment vehicle, and a potential source of tax-advantaged retirement income. But this is also where things get complicated, because permanent insurance isn't one single product. It's a category, a family of products. And the three main siblings in this family are whole life, universal life, and variable life. First, let's talk about the oldest, most traditional sibling, whole life insurance. This is the bedrock of the industry. Whole life is built on a foundation of guarantees. You get a guaranteed level premium that will never, ever increase. You get a guaranteed death benefit that will never decrease. And you get a guaranteed slow but steady growth rate on your cash value. It's designed to be the most predictable, stable, and conservative option. Think of it as the bond in your financial portfolio. It's not flashy, it won't see explosive growth, but it is built to be reliable and secure. Then you have the more modern, flexible sibling, Universal Life, or UL. Universal Life was created to give policyholders more control. Unlike the rigid structure of whole life, a UL policy allows you to adjust your premium payments within certain limits. If you have a tough financial year, you might be able to pay a lower premium. If you have a great year, you can pay more to build your cash value faster. The death benefit can also be adjusted. This flexibility is its main selling point. However, it comes at a cost. the guarantees are not as strong. The growth of your cash value is tied to current interest rates, which means in a low interest rate environment, your cash value might grow much slower than projected, potentially requiring you to pay higher premiums later in life to keep the policy from lapsing. It offers more control, but also more uncertainty. Finally, you have the youngest, most aggressive sibling, Variable Universal Life or VUL. This one takes the flexibility of universal life and adds a shot of Wall Street adrenaline. With a VUL policy, your cash value isn't just sitting in a conservative, interest-bearing account. Instead, you get to invest it in a selection of sub-accounts, which are essentially mutual funds. This means your cash value has the potential for massive, market-based growth, far beyond what whole or universal life could offer. But it also means you are taking on direct market risk. If your investments do poorly, your cash value could plummet. You could lose money, and in a worst-case scenario, you could lose so much that your policy collapses entirely unless you pour in huge sums of money to save it. It offers the highest potential reward, but also carries the highest potential risk. So let's pull back for a moment. We have two main roads. The term road is a straight, simple path designed for temporary protection at the lowest possible cost. The permanent road is a longer, more complex journey with three main lanes: the slow and steady whole life lane, the flexible universal life lane, and the high-speed variable life lane. Each one is designed to offer lifelong coverage while also building a cash value asset. The choice seems overwhelming, and we haven't even talked about the single biggest factor that stops most people dead in their tracks when they look at these options: the price tag. Just how much more expensive is a permanent policy than a term policy? And what are the hidden costs and commissions baked into these products that no one ever talks about? Is the promise of a lifelong asset really worth paying 5, 10, or even 15 times more every single month? That's where the real debate begins. And the debate begins with a single unavoidable number: the price tag. To understand the chasm between term and permanent insurance, let's stop thinking about it as insurance for a moment. Imagine you need a car. You go to a dealership. The first car, let's call it the term Toyota, is a reliable lease. It costs you $100 a month. It does exactly one job. It gets you from point A to point B safely for the next 20 years. If anything happens to it during that time, the company gives you a brand new one. Simple. Then the salesman shows you another car, the permanent Porsche. It also gets you from point A to point B, but this one costs $1,500 a month. The salesman explains that yes, it's more expensive, but it's an asset. You're not just leasing it, you're building equity. He tells you that after many years, you'll own it outright. And it will even have a special savings account inside the glove compartment that grows over time, tax-deferred. You can borrow from it, and one day it might even be valuable enough to cover its own maintenance costs. Faced with that choice, what's your first question? It's not just, is it worth it? It's, where is my $1,500 actually going each month? That is the single most important question you can ask about permanent life insurance. Because that massive premium isn't just one thing. It's a complex financial engine, and it's being split into 3 separate buckets every single time you make a payment. The first bucket is the simplest. It's the actual cost of the life insurance itself. Think of this as the pure mortality charge. It's the money the insurance company needs to cover the risk of you actually dying and them having to pay out that $1 million death benefit. Inside every single permanent life insurance policy is essentially a tiny term policy. And just like a regular term policy, the cost of this pure insurance goes up every single year as you get older. When you're 30, it's cheap. When you're 80, it's incredibly expensive. Keep that in mind because this escalating internal cost is a ticking time bomb we'll come back to. The second bucket is where things get murky. This is the fees and expenses bucket. And this is the part of the conversation that makes many insurance agents squirm. The biggest expense, especially in the early years, is the agent's commission. How big? Well, in the world of stocks or mutual funds, a commission of a few percent is standard. But with many types of permanent life insurance, the commission paid to the agent can be anywhere from 50% to over 100% of your entire first year's premium. Let that sink in. If your premium is $10,000 for the first year, it's possible the agent who sold it to you could walk away with a $10,000 commission check. Your entire first year's payment might not go towards your death benefit or your cash value savings. It could go directly to the salesperson and the insurance company's overhead. Imagine giving a financial advisor $10,000 to invest for your retirement, and at the end of the year they tell you your balance is zero because their fee was $10,000. You would be outraged. Yet, in this part of the financial world, that structure is business as usual. This is why permanent life insurance is often called a product that is sold, not bought. The financial incentive to sell these policies is one of the highest in the entire financial industry. And those fees don't stop after year one. There are ongoing administrative charges, premium load fees, and mortality and expense risk charges that are constantly being skimmed off your payments. So, after the cost of insurance is paid from bucket 1, and all those fees and commissions are paid from bucket 2, whatever is left over, the remainder, is what finally trickles down into the third bucket. This is the famous cash value. This is the savings and investment component that is supposed to be the beating heart of the policy. It's the reason you're paying 15 times more than you would for a term policy. But here's the brutal reality of how that trickling down works. Because of the massive upfront commissions and fees for the first several years of a policy, sometimes as long as 10 or 15 years, your cash value can be zero. Or it can be significantly less than the total amount of premiums you've paid in. You could pay $50,000 in premiums over 5 years and find that your cash value, the money you can actually access, is only $5,000. Where did the other $45,000 go? It was consumed by buckets 1 and 2. It was eaten alive by the cost of the insurance and the built-in fees. This leads us to the next layer of this financial labyrinth: the surrender charge. The insurance company knows that if people saw their cash value was so low in the early years, many would cancel the policy and run. So to prevent this, they build in a surrender period. If you want to cancel your policy and take your cash value out within, say, the first 15 years, you have to pay a steep penalty, a surrender charge. This penalty decreases over time, but it effectively acts as a golden handcuff, locking you into the policy during the exact period when it's performing the worst for you and the best for the insurance company. It forces you to keep paying into a system, hoping to one day break even on the money you've put in, let alone see the tax-deferred growth you were promised. Now let's go back to that ticking time bomb I mentioned, the rising internal cost of insurance. Remember how the pure insurance cost inside the policy gets more expensive every year? The whole system is designed so that your cash value, bucket number 3, grows fast enough to offset that. The idea is that in your later years, when the insurance cost is sky high, the earnings from your large cash value will be enough to pay for it, and the policy will sustain itself. But what happens if the cash value doesn't grow as planned? What if the market has a bad decade? Or the dividends the company projected don't materialize? Suddenly, you have a huge, rising cost of insurance and a small, stagnant pool of cash value to pay for it. The policy begins to eat itself alive. The insurance company will then send you a letter informing you that your policy is underfunded and at risk of lapsing. Your choice? Either start pouring thousands of dollars of extra, unplanned money into the policy just to keep it from dying, or walk away, lose the death benefit, and forfeit much of the cash value you spent decades building. It's a catastrophic failure point that millions of policyholders have faced, often in their 70s or 80s when they can least afford it. So you have a product with enormous front-loaded commissions that create a massive conflict of interest. You have a savings component that can take over a decade just to break even with the premiums you've paid. You have surrender charges that lock you in during the worst-performing years. And you have an internal, escalating cost structure that can cause the entire policy to implode on itself if your cash value doesn't perform exactly as projected on a fancy illustration decades earlier. Looking at it this way, it feels less like a Porsche and more like a car with a beautiful chassis but an incredibly complex, inefficient, and expensive engine that has a tendency to break down right when you need it most. It begs the question: if the mechanics are this challenging and the costs are this high, why on earth would anyone who understands this ever buy one? The truth is, most people don't understand it. They are sold the dream of a tax-free asset without ever being shown the blueprints of the engine. But there is another side to this story. For all its flaws and complexities when applied to the average American family, this same financial vehicle is used by the ultra-wealthy as a cornerstone of their financial empires. So if it's such a bad deal for most people, who is it actually for? Why do the wealthiest families in the country use these exact policies to transfer billions of dollars from one generation to the next, completely tax-free? Is there a secret strategy that only the 1% knows about? That's where we're going next, into the world of complex estate planning, infinite banking, and the legitimate, highly strategic uses of permanent life insurance. So, how do the ultra-wealthy use a simple tool like life insurance to pass on fortunes, completely tax-free? Is there a secret strategy that only the 1% knows about? That's where we're going next, into the world of complex estate planning, infinite banking, and the legitimate, highly strategic uses of permanent life insurance. To understand this, we have to You can use this for anything. A down payment on a house, starting a business, funding a college education. You are leveraging a pool of capital that you control that grows tax-deferred, and that is completely private. It's a financial fortress. This isn't a get-rich-quick scheme. It requires discipline and a properly structured, dividend-paying whole life policy. It takes time to build up significant cash value, but for those who commit to it, it's a powerful way to control your own financial destiny. Now let's scale this idea up. Way up. Let's talk about generational wealth. What's the biggest threat to passing a large fortune from one generation to the next? It's not bad investments. It's not spendthrift kids. It's the federal estate tax. As of right now, if you pass away with an estate worth over about $13 million as an individual, or $26 million as a married couple, every single dollar above that amount can be taxed at a staggering 40%. Think about that. You build a $50 million family business over a lifetime. You pass away. Your heirs are left with a massive tax bill. In this case, roughly $14 million. Where do they get that money? They often have to do the one thing you never wanted them to do, sell the business. They have to liquidate assets, sell off chunks of the empire you built just to pay the tax man. The tax destroys the legacy. So, how do the wealthiest families in America sidestep this? They use a tool called an irrevocable life insurance trust, or an ILIT. It sounds complicated, but the concept is brilliant in its simplicity. Think of an ILIT as a vault. It's a legal entity that you create, completely separate from yourself. You can't touch it, you can't change it, you can't control it. That's what irrevocable means. You work with an attorney to set up this vault, and you name your children or grandchildren as the beneficiaries of whatever is inside. Then, you start gifting money to the vault each year. You can use your annual gift tax exclusion to do this without any tax consequences. The vault then uses that money for one purpose: to buy a massive permanent life insurance policy on your life. The key here is that the vault owns the policy, not you. You have no ownership rights. You are simply the person who is insured. You continue to fund the vault continues to pay the premiums. You live your life. Then, when you pass away, the life insurance company pays out the death benefit. Let's say it's a $20 million policy. Where does that money go? It doesn't go to your estate. It goes directly into the vault. And because the vault is a separate entity, and you didn't technically own the policy, that $20 million death benefit is not considered part of your estate. It is completely 100% income and estate tax-free. The trustee of the vault then uses that $20 million of tax-free, liquid cash to pay the $14 million estate tax bill. The family business? It remains intact. The properties? They don't have to be sold. The legacy is preserved. The remaining $6 million in the vault is then distributed to your heirs, also tax-free. It is the ultimate financial checkmate against the estate tax. It's a legal, ethical, and incredibly powerful strategy that turns pennies on the dollar, the insurance premiums, into the exact amount of tax-free cash you need, at the exact moment you need it. These strategies, infinite banking and complex estate planning with ILITs, show that permanent life insurance is so much more than a simple safety net. In the right hands, it's a Swiss Army knife of financial tools. It's a private lending facility, a tax shelter, and a machine for generating generational wealth. But this power comes with a critical warning. Not all permanent life insurance is created equal. The strategies we just discussed typically rely on a very specific type of policy. Other types, which are often sold as being more flexible or modern, can carry hidden risks that can cause the entire structure to collapse, leaving you with nothing but tax bills and regret. So we have to ask the big question. What is the difference between whole life and universal life insurance? They sound similar, but they operate in fundamentally different ways. One is built like a bedrock financial institution, the other is built more like a risky investment portfolio. And understanding that difference is the key to either securing your future or gambling it away. Let's start with that bedrock financial institution, whole life insurance. Think of it as the financial equivalent of a brick house. It's not flashy. It's not going to double in value overnight, but it is solid, predictable, and built to withstand any storm. The entire structure is based on a single powerful concept: guarantees. When you buy a whole life policy, your premium is fixed. It is guaranteed to never change for your entire life. Whether you're 35 or 85, you pay the exact same amount. That premium payment is then split into three main buckets by the insurance company. The first bucket covers the pure cost of the death benefit. This is the fundamental insurance component. The second bucket covers the insurance company's overhead and profits. And the third, most crucial bucket, goes into your policy's cash value. This cash value is the living benefit of your policy, the part you can use while you're still alive. And here's the key. That cash value is guaranteed to grow every single day. The insurance company gives you a contractually guaranteed minimum interest rate. It might be something like 3 or 4%. It's not a thrilling number, but it is an unbreakable promise. Your cash value will grow by at least that much every single year, tax-deferred, no matter what is happening in the stock market, the real estate market, or the world. A market crash? Your cash value grows. A recession? Your cash value grows. It is a one-way street, but it gets better. Most whole life policies are issued by mutual insurance companies. This means the company is owned by its policyholders, not by stockholders. So, when the company does well, when its investments perform better than their conservative projections, it shares those profits with you, the owner, in the form of a dividend. Now, this dividend is not guaranteed, but many of the largest mutual companies in the US have paid them consistently for over 150 years. Through the Great Depression, World Wars, the dot-com bust, the 2008 financial crisis, the dividends kept coming. This dividend further fuels your cash value growth, creating a compounding effect that is slow, steady, and incredibly powerful over time. It's boring. It's predictable. It is the definition of a stable, long-term financial asset. Now let's look at the other side of the coin. The product that's often sold as a supercharged, modern alternative to old-fashioned whole life. This is universal life, and specifically indexed universal life, or IUL. This isn't a brick house. It's more like a high-tech concept car. It's sleek, it's flashy, and the sales pitch is almost irresistible. The pitch goes something like this. Why settle for a boring 3 or 4% in whole life when you can participate in the growth of the stock market? With an IUL, you get the market's upside with none of the downside risk. If the market goes up, you win. If the market goes down, you don't lose a dime. It's the best of both worlds. Sounds incredible. Too good to be true even. And to understand if it is, you have to look under the hood. Unlike whole life's fixed premium, an IUL has flexible premiums. You can pay more some years, less others. This flexibility is a major selling point. The cash value in an IUL isn't tied to the insurance company's conservative portfolio and a guaranteed rate. Instead, its growth is linked to the performance of a stock market index, most commonly the S&P 500. This is where the terms cap and floor come in. The floor is almost always 0%. This is the source of the no downside risk claim. If the S&P 500 crashes and loses 30% in a year, your cash value account is simply credited with a 0% gain. You don't lose money from the market drop itself, which sounds great. The cap is the maximum return you can be credited in a good year. If the S&P 500 soars and gains 25%, but your policy has a cap of, say, 9%, then 9% is the most you can get. So you get some of the upside, but not all of it. This trade-off, giving up some of the highest highs to eliminate the lowest lows, is the core engine of an IUL. On the surface, it makes a lot of sense. But this is where the risky investment portfolio part comes in, because the sleek exterior of an IUL hides some incredibly complex and dangerous mechanics. The first and most critical one is the cost of insurance. In a whole life policy, the cost of insurance is levelized and baked into your fixed premium. In an IUL, the cost of insurance is not level. It starts very low when you're young and healthy, but it increases every single year as you get older. It's a constantly accelerating expense inside your policy. In the early years, when you're young and the market is doing well, this isn't a problem. Your 9% credited interest easily covers the low internal costs and leaves plenty left over to grow your cash value. But what happens when you're older? Say in your 60s, one is designed to perform with certainty in an uncertain world. The other is designed to look good on paper, harnessing the allure of the stock market, while minimizing the appearance of its true long-term risks. So why, if one is so stable and the other is fraught with these hidden dangers, are IULs and other complex universal life products so incredibly popular and pushed so aggressively by agents? The answer comes down to one of the most powerful and misunderstood forces in the financial world. And it has nothing to do with what's best for you. That force is the commission. The single biggest driver of the life insurance product you are sold is not your needs, your budget, or your family's long-term security. It is the commission paid to the person selling it to you. This is the uncomfortable, often unspoken truth at the heart of the life insurance industry. It's the ghost in the machine, the invisible hand guiding the conversation in the agent's office, and it explains almost everything about why complex, expensive permanent policies are pushed so hard, while simple, affordable term insurance is often treated as an afterthought. To understand this, you need to see the numbers. And I warn you, these numbers can be shocking. Let's start with a simple term life insurance policy. If you buy a term policy with an annual premium of, say, $1,000, the agent or broker who sells it to you will typically earn a commission of somewhere between 40% and 90% of that first year's premium. So, on your $1,000 policy, they might make anywhere from $400 to $900. In the following years, they'll typically receive a very small renewal commission, maybe 2% to 5%, for as long as you keep the policy. It's a decent payday for the work involved, but it's not life-changing money. Now let's look at permanent life insurance. Whole life, universal life, indexed universal life. This is where the entire incentive structure gets supercharged. The commission on these policies isn't 40% or 70%. It is often 100%, 110%, or even more of the entire first year's premium. Let that sink in. If an agent convinces you to buy a whole life policy with a premium of $10,000 a year, their commission in that first year could be $10,000. Or $11,000. The insurance company literally pays the agent more than the total amount you paid in premiums for the first year. Suddenly, the sales pitch makes a lot more sense, doesn't it? Why would an agent spend hours trying to sell you a $1,000 term policy to make a $700 commission, when they can spend the same amount of time selling you a $10,000 permanent policy and make a $10,000 commission? That's more than 10 times the pay for the same amount of work. The financial incentive is so overwhelmingly powerful that it warps the entire process. It creates a fundamental, deeply ingrained conflict of interest. The agent's financial well-being is directly tied to selling you the most expensive product possible, regardless of whether it's the best solution for your needs. This is why the buy term and invest the difference argument is so aggressively attacked by many insurance agents. It's not because it's bad advice. For most people, it's excellent advice. It's attacked because it's bad for business. A term policy pays a fraction of the commission. The difference you invest goes into a 401k or an IRA, where the insurance agent makes nothing. Their entire financial world is built around convincing you that bundling your insurance and investments into one complex, high-fee product is the superior strategy. So where does this massive commission payment come from? The insurance company isn't just giving away free money. You are the one who pays for it. This system is funded by what's known as front-loading. The insurance company pays the agent's massive commission upfront, creating a huge deficit on their books for your specific policy. They then spend the next 10 to 15 years paying themselves back out of your premiums and your cash value growth. This is achieved through a dizzying array of internal costs, fees, and charges that act as a drag on your policy's performance. This is the secret behind the surrender charge. Remember how we talked about that penalty for cashing out your policy early? The surrender charge exists primarily to ensure the insurance company gets its money back if you decide to leave. If you cancel your policy in year 3, they haven't had enough time to recoup the massive commission they paid the agent in year 1. So, they hit you with a surrender charge to make themselves whole. Your penalty is literally paying off the last remnant of your agent's commission. Let's put this into a real-world context. Imagine two 35-year-old parents, both needing $1 million in coverage. The first parent meets with an advisor who recommends a 20-year term policy. The premium is about $600 a year. The agent makes a one-time commission of, let's say, $540. The parent is now protected, and they have thousands of extra dollars every year to invest for retirement or their kids' college education. The second parent meets with a different agent. This agent spends hours talking about tax-free growth, market-linked returns, and using life insurance as a personal bank. They build a beautiful illustration showing how a VUL or IUL policy can solve all their problems. They sell them a policy with a premium of $12,000 per year for that same $1 million death benefit. The agent walks away with a commission of over $12,000. The parent is now locked into a high premium plan, where for the first decade or more, a huge portion of their money is going toward fees and commissions, not building cash value. If they face a job loss in year 5 and can no longer afford the premium, they might have to surrender the policy, getting back only a fraction of what they paid in and losing their coverage entirely. One agent made $540. The other made over $12,000. Which product do you think has more training, marketing, and sales support behind it? Which product are agents more incentivized to master and sell? The system isn't broken. It's designed this way. It's a sales machine engineered to move the most profitable products, and profitability is defined by what benefits the company and the agent, not necessarily the policyholder. This isn't to say that every single agent selling permanent life insurance is a bad person. Many genuinely believe in the products they sell. They have been trained within this system, they've attended the conferences, they've seen the glossy marketing materials, and they've been taught that this is the best way to help clients. They see the huge commission as fair compensation for their expertise and the work of getting a complex policy issued. But the intentions don't change the math. The conflict of interest is still there, woven into the very fabric of the transaction. The financial gravity is too strong to ignore. It pulls every recommendation, every illustration, every piece of advice toward the high commission solution. So you're trapped. The very people who are supposed to be your trusted guides in one of the most important financial decisions of your life have a massive, often undisclosed, incentive to point you toward the most expensive and complex option. It can feel like an impossible situation, a game that's rigged from the start. How can you possibly get objective advice when the person giving it stands to make 20 times more money if you choose option A over option B? But what if there was a different kind of advisor? A professional operating under a completely different set of rules? A type of advisor legally, ethically, and professionally bound to act in your best interest, and only your best interest, not their own. Understanding this one distinction, this fork in the road of the financial world, could be the single most important decision you ever make for your family's future. So how do you make it? How do you find the right guide in a world filled with people who all sound the part? This isn't just about picking a name from a website. This is about finding the person you will entrust with the blueprint for your family's financial security. It's a job interview and you are the one doing the hiring. Let's start with where to look. You'll generally encounter 3 types of professionals. First, you have the captive agent. Think of them as company employees. A captive agent works for one specific insurance company, say State Farm, or New York Life, or Northwestern Mutual. They know their company's products inside and out. The upside? They can be incredibly knowledgeable about the policies they sell. The downside? They can only sell you their company's products. If another company across the street has a better policy for you or a cheaper one, they can't offer it. Their toolbox has only one brand of tools. It might be a great brand, but it's not the whole hardware store. Second, you have the independent agent, or broker. This person is a free agent. They aren't tied to any single insurance company. Instead, they have contracts with multiple carriers. This is a huge advantage. They can shop the market for you, comparing policies and prices from a dozen or more different companies to find the best fit. They have access to the whole hardware store. Their primary loyalty, however, is still to getting a policy sold because that's how they get paid, through a commission from the insurance company whose product you buy. While they have more options, their fundamental business model is still based on the sale of a product. And that brings us to the third type, the one we just discussed, the fiduciary financial advisor. Specifically, you might look for a certified financial planner, or CFP, who operates on a fee-only basis. These professionals are not primarily salespeople. Their product is their advice. You pay them directly, either an hourly rate, a flat fee for a project, or a percentage of the assets they manage for you. Because they aren't earning a commission from an insurance company, their incentive to sell you a specific policy disappears. Their only incentive is to give you the best possible advice for your situation. Because if they don't, you'll stop paying them. They will still use an agent or broker to place the policy, but the recommendation comes from a place of unbiased, fiduciary duty. So, you've identified someone you think might be a good fit. You schedule a meeting. What do? You pull out your list of non-negotiable questions. This is your script. This is how you take control of the conversation and find out exactly who you're dealing with. Question number 1, the absolute deal breaker. Are you a fiduciary, and will you state that in writing? It's a simple yes or no question. If they hesitate, if they use fuzzy language like "we always put our clients' needs first," or "we act in a fiduciary-like capacity," that's a red flag. A true fiduciary will say yes, absolutely, without blinking. They'll be proud of it. If they can't or won't put it in writing, you thank them for their time and you walk away. End of interview. Question number 2. How do you get paid? This is not a rude question. It is the most important business question you can ask. You need to know exactly where the money is coming from. Are they commission-based? Meaning they only get paid if you buy a product. Are they fee-based? This is a tricky one. It sounds like fee-only, but it's a hybrid. They can charge you a fee for advice and earn a commission on products they sell. This creates a potential conflict of interest. Or are they fee-only? This is the gold standard for unbiased advice. They are paid only by you, the client. There are no commissions, no kickbacks, no hidden incentives. Their advice is clean. Understanding this distinction is like turning on the lights in a dark room. Question number 3, for anyone who isn't a captive agent. How many insurance companies are you contracted with? If they're a broker, you want to see a wide range of options. If they only work with 2 or 3 companies, they're not much better than a captive agent. You're looking for someone who can truly scan the entire market for the best possible solution for you. And question number 4, a powerful one they might not expect. Could you walk me through your process for determining a client's life insurance needs? A great advisor won't just jump to a product. They'll talk about a comprehensive needs analysis. They'll ask about your income, your debts like a mortgage or student loans, your children's ages, your future education goals for them, your spouse's earning potential, your retirement plans. They should be building a detailed picture of your life. If their first move is to pull out a brochure for a complex whole life policy and talk about its investment returns, they're not advising, they're selling. Now, just as important as the right questions are the warning signs. Let's call them the giant, flashing red flags that tell you to run, not walk, to the nearest exit. Red flag number 1, high-pressure tactics. If you ever hear phrases like, "This rate is only good for today," or "You need to sign now to lock this in," it's a sales tactic designed to short-circuit your decision-making process. A life-altering financial decision should never be made under pressure. A true professional will give you all the time and space you need to feel comfortable. Red flag number 2, a lack of transparency. If they're cagey about how they're paid, or they can't give you a straight answer about being a fiduciary, that's a massive problem. This is your financial future. Secrecy and vagueness have no place in it. Red flag number 3, they push one type of product for everyone. Life insurance is not one size fits all. If the advisor seems to have a favorite hammer, often a complex, high-commission permanent life insurance policy, and they see every client as a nail, be very wary. A good advisor's recommendation will be custom-tailored to the analysis they did of your specific life. Red flag number 4, they make you feel stupid. A good advisor is an educator. They should be able to explain complex topics in simple, understandable terms. If you ask a question and they dismiss it, talk down to you, or use a fire hose of jargon to confuse you, they're not trying to help you. They're trying to control you. Your questions are valid. Your concerns are real. Anyone who makes you feel otherwise doesn't deserve your business. Think of 2 people, Sarah and Tom. They're the same age, same health, same family situation. Sarah walks into the office of a slick, commission-based agent. He doesn't ask many questions about her life, but he shows her fancy charts about a cash value policy that he calls a savings account on steroids. He pressures her, says the rates are going up next week. Feeling overwhelmed, Sarah signs up for a policy with a $400 monthly premium. Tom, on the other hand, does his research. He finds a fee-only certified financial planner. He pays a flat fee for a comprehensive financial plan. The planner spends 2 hours asking about Tom's goals, his fears, his dreams for his kids. After the analysis, the planner recommends a simple 20-year term life insurance policy. It has no cash value, no investment component. It just provides a massive death benefit for the 20 years his family is most vulnerable. The planner then uses an independent broker to find the absolute best rate on that policy from over 15 different companies. Tom's premium? $60 a month. Sarah has an expensive, ill-fitting product. Tom has an affordable, perfectly suited solution. The only difference was the guide they chose at the very beginning. Choosing your guide is the strategic part of the game. It's the single biggest lever you can pull to ensure you get the right outcome. Once you have that person in your corner, that true fiduciary, that expert guide, you're ready to actually approach the insurance company. You're ready to apply. But this is where the tables turn. Up until now, you've been the one asking the questions, you've been the one in charge. Now, the insurance company gets to put you under the microscope. And what they find there, in your health, your history, and your habits, can change everything. It's a process called underwriting. And it's the most misunderstood, and often most feared part of the entire journey. So you've filled out the application. You've dotted the I's, crossed the T's, and sent it off into the digital ether. What happens next isn't magic. It's a forensic investigation into you. The underwriting process is where the insurance company moves from taking your word for it to verifying everything. They are, in essence, trying to answer one single multi-million-dollar question. How likely are you to die sooner than expected? It sounds morbid, but to them it's just math. They are calculating risk. And to do that, they become detectives assembling a complete file on your life. The first and most significant piece of evidence they gather is your medical history. This is where the infamous life insurance medical exam comes in. For most policies, especially those with larger death benefits, a paramedical professional will come to your home or office. It's convenient, but it's also incredibly thorough. They'll measure your height, weight, and blood pressure. They'll ask you a series of detailed health questions, many of which you just answered on the application. They're checking for consistency, but the real truth serum is in the samples they collect. A blood sample and a urine sample. These two tiny vials tell a story about you that you might not even know yourself. They're not just looking for major diseases like HIV or cancer. They're analyzing everything. Your blood will be screened for cholesterol levels, the good HDL, the bad LDL, and your triglycerides. High levels could signal a future risk of heart disease. They'll check your A1C levels, a marker for long-term blood sugar control, which can uncover undiagnosed diabetes or prediabetes. They'll look at your liver and kidney function, which can be affected by everything from diet to alcohol consumption. The urine sample is screened for nicotine, cotinine to be exact, the telltale sign of tobacco use, as well as for drugs, both prescription and illegal. Think of it this way. Two 45-year-old men, both non-smokers, both the same height and weight, apply for the exact same policy. On paper, they look identical, but the blood work for man A comes back perfect. Man B's blood work, however, shows elevated liver enzymes, borderline high cholesterol, and an A1C that puts him in the pre-diabetic range. Suddenly, these two identical applicants are worlds apart in the eyes of the underwriter. Man A is a low risk. Man B is a higher risk. That single blood test could mean the difference between getting the best possible rate and paying double or even being denied altogether. And the investigation doesn't stop with the exam. The underwriter will pull your official medical records from your doctors. They do this through the Medical Information Bureau, or MIB. The MIB is like a credit bureau for the insurance industry. It holds a record of your previous insurance applications, so if you applied for a policy 5 years ago and disclosed a health condition, they'll know about it. They'll see the notes from your last physical, the medications you've been prescribed via a prescription database check, and the treatments you've received. They're building a timeline of your health. But your physical health is only one chapter in your story. The next chapter is your lifestyle. This is where the questions get even more personal. Do you have any dangerous hobbies? If you're a weekend skydiver, a scuba diver who explores deep-sea caves, or a private pilot, underwriters see that as an added layer of risk. They'll likely still insure you, but they might add something called a flat extra, which is a surcharge on your premium for every $1,000 of coverage. They'll also look at your driving record. A few speeding tickets might not move the needle much, but a DUI or a history of reckless driving convictions signals a pattern of high-risk behavior that makes underwriters extremely nervous. They'll also ask about your travel plans. Are you planning any trips to countries on the U.S. State Department's Do Not Travel list? Insuring someone who is about to travel to a war zone is a risk most companies are unwilling to take. And then there's the biggest lifestyle factor of all, smoking. Using any form of nicotine, cigarettes, cigars, vaping, chewing tobacco, will immediately knock you out of the running for the best rates. Smoker rates can be 2 to 5 times higher than non-smoker rates. This is the one area where people are most tempted to lie, thinking, I'll just quit a few weeks before the exam. But it's a terrible idea. As we mentioned, they test for cotinine in your urine, which can stay in your system for weeks. And even if you somehow pass that test, lying on a life insurance application is fraud. If you die within the first 2 years of the policy, a period called the contestability period, the insurance company will launch an even more intense investigation. If they find out you lied about your smoking habit, they can, and absolutely will, deny the claim, leaving your family with nothing. It's just not worth the risk. Next, the underwriter turns the page to your family history. This part can feel unfair because it's the one thing you have absolutely no control over. They're looking for a history of hereditary conditions. Did one of your parents or siblings die from heart disease or cancer before the age of 60 or 65? If so, it flags a potential genetic predisposition. Even if you are in perfect health today, an underwriter might see that family history as a shadow in your future, a statistical likelihood that you could face the same fate. It can prevent you from getting the absolute top-tier rates, even if you've done everything right in your own life. Finally, the underwriter looks at your finances. This surprises a lot of people. Why does an insurance company care how much money you make? It's because of a concept called financial justification. The purpose of life insurance is to replace a financial loss that your death would cause. So the amount of coverage you're applying for needs to make sense relative to your income and your net worth. You can't be a student making $20,000 a year and get approved for a $10 million policy. There's no financial justification for it. The underwriters are making sure the policy isn't a motive for foul play or a speculative bet, but a legitimate tool for financial protection. Once the underwriter has collected all this evidence, your medical exam, your doctor's records, MIB report, prescription history, driving record, and financial information, they piece it all together to make their final judgment. They assign you a risk classification. Think of it like a credit score for your life. The very best classification is Preferred Plus or Super Preferred. This is for the gold standard applicants, people in excellent health, with a clean family history, a safe lifestyle, and ideal height and weight. They get the lowest possible premiums. Just below that is Preferred. This is still for people in great health, but maybe with a minor, well-controlled issue like slightly elevated cholesterol that's managed with medication. Next is Standard Plus and Standard. This is the category where most people land. You might be a little overweight, have slightly high blood pressure, or have that early heart disease in your family history. You're still considered a reasonable risk and you'll get a fair average rate. If you have more significant health issues like a recent cancer diagnosis, a heart condition, or uncontrolled diabetes, you may fall into a substandard category. These are often called table ratings, where your premium will be the standard rate plus an extra 25% for each step down the table. After weeks of this intense scrutiny, you finally get the verdict. The insurance company comes back with an offer. They might approve you at the rate you applied for. They might approve you but at a higher rate based on your risk classification. Or, in some cases, they might postpone a decision, asking you to get a condition under control and reapply in a year. And sometimes they might deny you outright. But a denial isn't a life sentence. It just means that, based on their specific set of rules, you were too high risk for that particular company at that particular time. This is where a good independent agent is crucial, because they can take your file and shop it to other carriers who might have more lenient underwriting for your specific condition. You've been weighed, you've been measured, you've been approved. The offer is on the table, a formal contract outlining the price for protecting your family's future. But now comes the final critical decision. The moment you accept the policy and make your first payment. And that's where the rubber truly meets the road, turning a simple application into a powerful binding promise. And this promise arrives in your hands, not as a handshake, but as a thick packet of paper or a secure digital file. Your official life insurance policy. This is the moment of truth. When you receive it, you're not just getting a document. You're being given one final crucial opportunity to review every single detail. This is called the free look period. In most states, this gives you anywhere from 10 to 30 days to read the policy front to back, no strings attached. This is your safety valve. You get to see the contract in its final form, the exact death benefit, the precise premium, the specific terms and conditions, all the riders you selected laid out in black and white. During this period, ask yourself the hard questions one last time. Does this policy truly meet the needs we identified all those steps ago? Are the premiums manageable for my budget not just today, but for the next 20 or 30 years? Is there anything in the fine print that gives me pause? If you find something you don't like, or if you simply change your mind, you can return the policy for a full refund of any premium you've paid. No questions asked. This isn't a trick. It's a consumer protection law designed to ensure you are 100% confident in your decision. Once you're satisfied, you make that first premium payment, and the free look period expires. That's it. The policy is officially in force. The promise is now active. That immense, intangible concept of financial security has just become a real legally binding contract. From this day forward, your responsibility is simple. Pay the premiums on time. Think of it less as a bill and more as funding a trust. With every payment, you are fueling the engine of that promise, ensuring it remains ready. Most companies offer grace periods, typically around 31 days if you miss a payment. But it's critical to understand that if the policy lapses due to non-payment, the promise is broken. The coverage ceases to exist. This is why setting up automatic payments is one of the smartest things you can do. You set it, forget it, and maintain your peace of mind knowing that your protection is steadfast. But a life insurance policy isn't meant to be a static document you file away and never think about again. Life happens. It's dynamic and unpredictable. That's why you should plan to review your policy every few years, and especially after major life events. Did you get married? You'll likely want to update your beneficiary from, say, a parent to your new spouse. Did you have a child? Your financial needs just grew exponentially. That million-dollar policy that seemed like a fortress might now feel like a small fence. It might be time to consider a new, larger policy to cover the cost of raising a child and funding their education. Did you buy a new house? The mortgage is a massive new debt that your family would be saddled with. Your life insurance should, at a minimum, be enough to pay off that mortgage so your family can stay in their home no matter what. Maybe you started a business, got a major promotion, or took on the responsibility of caring for an aging parent. Each of these events changes your financial picture and the needs of the people who depend on you. A good policy is flexible. If you have a term policy, you might have the option to convert it to a permanent policy later in life without having to go through underwriting again. This can be an incredibly valuable feature if your health has changed. The key is to see your policy not as a one-time purchase, but as a living part of your overall financial plan, one that needs to adapt and grow as your life does. And then the unthinkable happens. The very event this entire process was designed for. A loved one passes away. In the midst of grief and chaos, the last thing a family should have to worry about is money. And because of this planning, they don't have to. This is where the promise is finally fulfilled. The process of filing a claim is intentionally straightforward. The beneficiary, the person you named in the policy, will need to contact the insurance company. They will need two key things: a certified copy of the death certificate and a completed claim form, which the insurance company provides. Once the paperwork is submitted, the insurance company begins its verification process. They'll confirm the policy was enforced, that the premiums were paid, and that there were no falsehoods on the initial application, especially within that 2-year contestability period we talked about. But let's be clear about a common myth. Insurance companies are not looking for excuses not to pay. They are in the business of paying legitimate claims. It is the very foundation of their industry. In the vast majority of cases, once the claim is verified, the process is quick. The death benefit, that tax-free lump sum payment, is typically paid out within a few weeks, sometimes even days. And that money, it's more than just money. It's a lifeline. It's the mortgage payment that gets made, keeping the family in their home. It's the utility bills that stay on. It's the grocery money that puts food on the table. It's the future college tuition that still gets paid. It's the space for a family to grieve without the crushing weight of immediate financial collapse. It is the final, tangible expression of love and forethought. It is the quiet, powerful fulfillment of a promise made years, or even decades earlier. So let's pull back and look at the entire journey we've just taken. We started with a simple question: what is life insurance? And we discovered it's not a product about death. It's a tool for life. It's a way to ensure the people you love can continue their lives with financial stability. We navigated the two great continents of this world: term life, the affordable protection for a specific period, and permanent life, the lifelong coverage with a cash value component. We explored the powerful customizations, the riders, that can allow you to access benefits while you're still living or protect your children. We pulled back the curtain on the mysterious underwriting process, understanding how your age, your health, and your lifestyle are translated into a risk assessment that determines your premium. We walk step by step through the application, the medical exam, and the approval, all the way to this final moment of accepting the policy and putting that powerful promise into force. We've seen how this promise is maintained over the years, and most importantly, how it is fulfilled in a family's greatest hour of need. You now know more about how life insurance works in the United States than the vast majority of people. You have the knowledge to cut through the jargon, to ask the right questions, and to make an informed decision that is right for you and your family. The next step is not to rush out and buy a policy tomorrow. The next step is to take this knowledge and apply it to your own life. Sit down, perhaps with a financial advisor, perhaps just with a notepad, and calculate your actual need. Have that conversation with your partner, with your loved ones. It might be uncomfortable, but it is one of the most important financial conversations you will ever have. Because in the end, life insurance is a story. It's the story of who and what you value most in this world. It's a story written in advance, a final chapter that you get to control. It says that even if you're not there to provide for your family, your love and your protection will be. It's the peace of mind that comes from knowing you've done everything in your power to secure their future. It is quite simply a promise kept.